Hello clients. Well, a series of events over the last several days has been the catalyst behind the volatility that we've experienced since late last week in the equities markets. The Federal Reserve cut the discount rate by 25 basis points on Wednesday of last week, and the post-meeting remarks left more questions than were answered. In my opinion, they took the worst of all possible paths. A quarter point does little to stimulate economic activity, and one could argue, given current economic trends, that no rate cut was necessary. Some wanted a much larger rate cut, and others wanted none at all. The Fed landed in the middle and appeased no one, and failed to adequately justify their actions nor clarify their future objectives, and the market reacted with a sharp sell-off. By noon of the following day, last Thursday, the markets had nearly recovered from the previous day's loss when President Trump tweeted about the imposition of a new 10% tariff on $300 billion of Chinese imports. The Dow Jones Industrial Average swung by nearly 600 points intraday following the tweet and continued the decline into Friday and so far today into Monday of this week. Markets are repricing the risk of an escalating trade war and the impact that such might have on economic output. That could have an impact on employment and income, consumer confidence, and thus patterns of spending. The markets are pricing into themselves assumptions about future economic activity given the events of last week. Nonetheless, we are in the middle of another strong period of earnings reports. Last week, we learned that the Conference Board's Consumer Confidence Survey came in at 135.7, which was much stronger than anticipated and one of the strongest readings since the 2008 recession. Personal income rose by 0.4%, and personal spending rose by 0.3%. And when annualized, wages and spending have grown by a greater amount year over year than we've seen since the 2008 recession. There are many economic indicators that reflect strength and expansion, while the majority of the S&P 500 companies that have reported earnings and revenues that have exceeded expectations. The market, in other words, is being moved by perception. Perception can change on a dime. If you'll recall, the market was up nearly 1,100 points on the 26th of December as perceptions changed on a dime, and short covering gave rise to what eventually became new all-time record closing highs in July. When macroeconomic data is this strong, and companies are reporting results that are this strong, and market volatility is based on assumptions that may not come to fruition, it's a time for evaluating the merits of either acquiring more shares and diluting the cost basis of what you already own, or remaining focused on your long-term objectives and weathering the storm. Now, as we've seen in the past, markets can move quickly and in both directions. If the fear and angst of a perception-born period of volatility entices you to sell out of a market, then you run a real risk of being out of the market if perceptions change in the other direction, and just as violently. Look, as always, call with your concerns and needs of clarity. Thanks for your time.